Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled The Outlook for Global Oil Demand During the Energy Transition. We're grateful to our moderator, Adam Sieminski, and our distinguished panelists for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our panelists, please use Zoom's Q&A button at the bottom of your window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. Now it's my great pleasure to introduce you to our moderator, Adam Sieminski, Senior Advisor to the Board of Trustees at the King Abdullah Petroleum Studies and Research Institute, CAPSARC, in Saudi Arabia. Adam, over to you.
Thank you very much, Dave, and welcome everybody to another of the incredibly worthwhile webinars being sponsored by the International Association for Energy Economics. Today, we're focusing on the outlook for global oil demand during the ongoing energy transition. Global oil demand historically has been forecast to basically increase over the indefinite future, and certainly the next decade or two, because of strong population growth and economic growth in developing nations. Now, this consensus is being replaced by significant uncertainty about the trajectory for global oil demand. In the short term, COVID's effects have been dramatic, and in the longer term, the movement to reduce carbon dioxide and other greenhouse gas emissions is a factor in forecasts, suggesting that global oil demand may already have peaked and could significantly decline. The energy transition is being driven by the interplay of increasingly complex dynamics, making it hard to predict future pathways. So this webinar looks at the range of possible trajectories for global oil demand and the underlying drivers responsible for differences in views. It also addresses the market implications for these views. We have 3 fantastic panelists today: Marianne, Tim Gould, and Eirik Wærness. I'll first introduce Marianne and then in sequence, Tim and Eirik. Marianne is a research scholar and advisory board member at the Center on Global Energy Policy at Columbia University. She was the chief economist of ConocoPhillips for 25 years, responsible for development of the oil and natural gas market outlooks for that company. She was also the firm's expert in scenario planning. Marianne has been the president of the U.S. Association for Energy Economics, one of the subgroups of the IAEE. Marianne, we're delighted to have you here, and over to you, please, to share your screen and give us your presentation. Thank you.
I'm delighted to be here.
All right, and we're waiting for your screen to come up.
Okay.
And we can see it.
Let me go back to the beginning. Here we go. So what I'm going to do this morning is to talk about a study that CGIP, the Center for Global Energy Policy, and the UC Davis Institute for Transportation Studies recently conducted on the impact of COVID on the energy transition and global oil demand. So I'm going to base many of my remarks on this study, and there's a link to the study on the bottom of the slide. So first, to sort of position us as what has happened recently, this slide is showing you the change in oil demand in 2020, in 2021, and 2022. And this is the IEA's estimates and forecasts versus what happened during the financial crisis. just to remind people what a steep decline we had in 2020, 9 million barrels a day. And if you look back to the financial crisis in 2008, over 2 years, we only lost 1.5 million barrels a day. So this is really a big deal when it comes to oil demand. Also, I'm showing you the IEA's forecast for 2021. What you can see is they're only expecting that 60% of what was lost comes back this year. And their forecast for 2022 shows you basically regain what you've lost in 2020 by the end of that year. But the reason why this is such a big, different phenomenon than the past is that you can see in the past, the financial crisis was mostly an OECD issue. You actually still had demand growth in the non-OECD or developing countries. This time around, it affected both. So not all demand was impacted equally during the crisis. And this is showing you the 2020 versus 2019, and then 2021 versus 2020. Again, thank you, Tim. I'm using IEA's numbers. And you can see that jet fuel was the most adversely impacted product. In fact, international air travel was down by 76% last year, and domestic travel was down by 50%. The first half of this year so far, we're seeing international is still down by 67%. So this is still greatly impacted, but domestic travel has improved. It's only down 33% versus 2019 levels. Gasoline demand was more resilient. First of all, people believe that personal vehicles are safe. In fact, we saw this phenomenon in the US where there was a large purchases of used cars for people who didn't own cars because they didn't want to take mass transit. And people also substituted short flights or flights under 500 miles by driving instead. Diesel demand was also a bit more resilient than gasoline demand because trucking and agriculture tended to remain robust, and e-commerce increased trucking. The fuel that actually was most resilient was the LPG and naphtha demand because you were making petrochemicals, and I'll come back to that in a moment. So in 2021, the IEA's forecast shows that gasoline and diesel are expected to recover about 2/3 of their demand lost in 2020, whereas jet fuel only recovers about 1/3. So I just wanted to show you a rough indicator of how driving has come back. And I'm showing you data from Apple's mobility app based on people requesting directions. And this is a really rough indicator. The baseline was January of 2020, but you shouldn't take this as an exact where, X above the baseline. This is really just a directional look. And you can see that both in the US and India and in Germany, we've seen a substantial increase and improvement in driving, even though there were many dips in between for COVID. Now, the one fuel that really hasn't come back is the air travel. And business travel is generally slow to come back after a recession. But with the improvements we've seen in teleconferencing, such as Zoom and Teams meetings, this may preempt a recovery. This is showing you the approximate share of airline traffic allocated to different business travel. Direct sales and securing clients is only 25% of business travel, and that will probably come back 100% eventually. But but other than that, all of those other categories, I believe, are at risk. And this, I think, would have a profound impact on major airlines who cross-subsidize passenger travel with business travel. They will have to raise their rates, and this could really just change their operating model. So this is a big deal that needs to be watched. So let me talk about the real question at hand and whether there really has been structural impacts of COVID on global oil demand. And I can argue both sides, but I think there could be a permanent downshift in global oil demand. And let me first explain the reasons why that could be. Government climate policies are accelerating the energy transition, and COVID seems to be accelerating those policies. One way is through green stimulus, with governments incentivizing things like the purchase of EVs and charging infrastructure. Given all the wildfires and floods we've had in the world, along with the increased sense of vulnerability due to COVID, the public appears to have become more accepting of actions to reduce greenhouse gas emissions. And there was a Pew Research survey, at least in the US, in the middle of COVID, that really demonstrates that. There's also a renewed focus of clean air in cities, in part because people experienced clean air for the first time during COVID. Also, low-income neighborhoods have greater pollution, and there's been studies that link pollution to deaths from COVID. So this has become a very large environmental justice issue. Another way that COVID has structurally reduced demand is through the acceleration of digitalization trends that have reduced the need for mobility. Telecommuting is one obvious example. In the US, where I live, 70% of the workers at the peak were telecommuting versus 7% beforehand. And I think we'll return to a hybrid model. I'll mention e-commerce also had growth internationally, great growth last year. In the US, it grew by 44%, the highest annual increase in at least 2 decades. And online sales in the US are now up to 21%, and other countries are following. I'll now turn to the aspects of COVID that structurally increased demand. The first one I've already referenced, the dominance of personal vehicles and the reduction in the use of mass transit. So there are aspects of COVID that increased vehicle miles traveled. Also, we've seen movement out of the largest cities, in the US anyway, to suburbs and smaller cities where there's less mass transit and people drive more. Digitalization can also encourage driving. Everyone thinks that telecommuting gets rid of demand, and it did last year. But when COVID is gone and people feel free to do other things, telecommuters may spend more free time dried up driving for other reasons. In fact, several studies in the past indicate that telecommuters tend to drive more than non-telecommuters. Also, e-commerce with frequent deliveries can end up increasing miles traveled by trucks more than the miles lost by consumers driving to retail stores. And finally, the increase in single-use plastics that we saw out of COVID for personal protection equipment, food takeout containers, and e-commerce packaging. The first may go away when COVID goes away, but the other two are probably to some degree here to stay. So we developed scenarios in our study, and there were 44 energy and transportation experts who worked on these scenarios of different pathways for COVID and government climate change. Those were the 2 key uncertainties. So in the upper left and roaring 20s, we have a strong early recovery in COVID, a very high energy demand, and greenhouse gas emissions are rising, and governments do take action globally to reduce greenhouse gas emissions. Moving to the right, in forced revitalization, COVID doesn't go away quickly, and climate policy is used as a way of green stimulus and completely revitalizing economies. So there's lots of investment in clean technology in this scenario. In the lower right quadrant, survival, COVID continues for a long time, and governments just aren't capable of dealing with it. And they certainly aren't going to enact policies that raise energy costs. And in quadrant 3, delayed carbon action, the last one, their countries delay action until there's a recovery from COVID. And action takes place at different speeds. Obviously, Europe, it takes action sooner than other countries. So I wanted to show you the scenario modeling results that came out of this study. And you can see that the dark lines or the solid lines are the scenarios from our study. The dots and circles and triangles are all commonly referenced forecasts, including all of the IEA forecasts, and focusing on 2030. So the first observation I want to make is that in 3 out of the 4 scenarios, global oil demand does not peak before 2030, which is the year our scenarios end and our projections end. The only scenario with an earlier peak had a double whammy of very low economic growth from continued COVID, along with stringent global climate policy. Now, these 4 scenarios generally encompass a range of forecasts through 2030. However, you start to see the demand from forecasts with 1.5-degree carbon trajectories, like the BPs and the IEAs, start to diverge below, in the case of the IEA, way below what our scenarios are showing. Forced revitalization came closest to it, but it was still higher than those scenarios. And the reason why it wasn't lower, given the high debt levels and concerns about massive fiscal spending, our scenario team thought it was unlikely that green stimulus in this scenario would be sufficient to move the world fully to a net zero trajectory. Now I wanted to show it to you by sector. Sorry, I'm too far. Looking at it by sector, This chart is showing you expected growth from 2019 to 2030 by sector. And I'm also showing you the IEA stated policy or STEP scenario in the front. So with the exception of forced revitalization, our other scenarios had significant growth in petrochemical and truck demand, driving overall global oil demand growth in 2030 versus 2019. However, one thing I wanted to highlight is in the bright blue, which is the passenger vehicle sector, there was only one scenario where there was actually growth during this time period in passenger vehicle demand, and that was a delayed carbon action where there were constraints on fuel efficiency and electric vehicle penetration. Because remember, governments were avoiding doing anything till COVID was fully over. So I'd like to make some key observations from the study. Global oil demand doesn't seem likely to peak before 2030 unless there's a combination of weak economic growth and aggressive government climate policy. In the past, environmental policy has been more likely to be enacted when the economy was strong, but it could be different this time due to the need for economic stimulus and an unprecedented need for economic stimulus. But even if global oil demand peaks prior to 2030, it's unlikely to decline precipitously before then. It takes many years to turn over global vehicle fleets, and when cars are initially retired, they don't go away. They move to the used car market, and they often move to developing countries. I also previously mentioned how the growth in petrochemical and truck demand generally is going to offset declines in the passenger vehicle sector in this time period. That may not be true post 2030. And I also mentioned previously that there are aspects of COVID that are actually increasing vehicle miles traveled. A third observation is that with current policies that are contemplated, the world is unlikely to get on the net zero 2050 trajectory by 2030. In our most aggressive case, we assumed EVs were 40% of new car sales by 2030 versus 5% today. This compares with the 60% sales rate the IEA says is needed to be on the net zero trajectory by 2030. There are challenges, though, of moving to this net zero trajectory. There may be higher EV penetration rates for new car sales in Europe and China, but it's going to be difficult to get particularly the developing country regions to invest and move along at the same pace. Other challenges include the size and speed of the required investment in energy infrastructure and investment. According to the IEA, investment in clean energy and energy infrastructure would have to triple by 2030. Energy intensity would have to fall at a rate 2.5 times faster than we've seen historically. And almost 50% of the emissions reductions in IEA's pathway would have to come from technologies that aren't yet commercially available. It's difficult to get developing countries to fund these investments when they are more focused on accessing electricity and clean cooking fuels for people for the first time. In advanced countries, it's difficult to permit key infrastructure that would be needed. Take transition lines in the United States. And a final observation is that with the rising ESG movement among investors, it's constraining spending on new oil supplies. Along with the high natural decline rates we see in oil, global oil supply may not keep pace with global oil demand during the next decade. That could result in periods of high oil prices. And the worry there would be, could it result in political backlash against the energy transition? So I'll stop there and be happy to answer questions later. Thank you. You're muted.
Thank you, Marianne. Thank you. And I'm now off mute. Tim can start sharing his slides. Tim, if you want to bring those up. Tim Gould is the chief energy economist at the International Energy Agency in Paris. He provides strategic counsel on energy economics across a wide range of IEA activities. He also leads the Energy Supply and Investment Outlook for the IEA. He co-leads the IEA's World Energy Outlook, the flagship publication, and he oversees the agency's work on investment and finance. Earlier, Tim served as an advisor at the Energy Charter. Tim, over to you, please. Thank you.
Well, thank you very much, Adam, and thank you very much to the IEE for the kind invitation. I'm going to get straight into these slides, and I realize now I'm treading in the very distinguished footsteps of our chairman, Adam Sieminski, in illustrating some of my points with old economist covers. This is a selection of covers over the last 20 years. And the left-hand side one from 2003, where the economist argued that advances in technology are offering a way to loosen the grip of oil. And I wanted to, I found it quite interesting looking at the text of that yesterday, which technologies did the economist have in mind when it talked about the threats to oil? And this is a quote from that article: "Hydrogen fuel cells and other ways of storing and distributing energy are no longer a distant dream, but a foreseeable reality." And the next solution after hydrogen was biofuels. I mean, there's no very prominent mention of electricity there. The middle cover is from 2013, where the economist opined that, it pointed to us at the IEA, as well as other institutions producing forecasts and projections, saying, we don't believe them. We don't think demand will keep on rising. We think that oil is close to a peak. And they gave two reasons for that. One of them was the shale revolution, where cheap shale gas would displace oil in certain transport applications. And then again, technology, efficiency. And there, although here we did see a mention of the growing popularity of electric and hybrid cars. And then the last, there's been a selection of covers that we could have picked from the last few years, but all with this theme about a new chapter in oil's story is unfolding. And yet, as Marianne mentioned, you have to be quite brave to argue that oil demand has already peaked. I mean, we are heading back upwards, back above pre-crisis levels sometime next year. I mean, that's certainly the picture that we get from near-term IEA analysis. I won't go into these near-term questions in detail because Marianne did such an excellent job with that just now. Just to amplify a couple of points, you can see the distinguishing dynamics here, the elements showing growth relative to 2019, mainly petchem feedstocks, where all of the transport fuels, particularly aviation, are well below where they were. And the same is true if you adopt a sort of regional perspective. Oops, sorry, now I've gone well ahead of where I was supposed to be. There we go. Underlines importance of emerging economies, particularly in Asia, while advanced economies, Europe, are still noticeably lower than where they were in 2019. I'd like to zoom in a little bit on the transport sector, since, as everyone is aware, road transport, large share of total oil demand. In a particular, this is all context from our most recent electric vehicle update. So this is a little bit the state of play with the electrification of transport. At the end of 2020, more than 10 million electric cars on the road worldwide, 2/3 of those battery electric vehicles, and almost half of the global stock of electric cars is located in China. However, as you can see on the screen, it's really Europe that's come through quite strongly for policy-driven reasons with electric vehicle sales. And that's, weathered the storm of the pandemic really quite very effectively. Global car sales last year were down quite sharply. EVs pretty buoyant in some of these key markets. So 1 of every 20 new cars sold in 2020 was electric. But again, very clear from this slide, the concentration of sales in markets with supportive policies. Very meager outside Europe, China, and parts of the US. And it's no coincidence that there's a very similar trend if you look at charging infrastructure. Overwhelmingly concentrated in those same markets. In our view, are around 1.3 million publicly accessible chargers in place as of the end of last year. More than half of those are in China. Let's have a quick look. There's obviously policy momentum. I'll come back to that. But we have to have in mind that electrification, much broader than cars, and particularly for some emerging, developing economies, the most electrified road transport sector is 2- and 3-wheelers. 10 times more units sold in 2020 than cars. Almost 1 in every 3 2- and 3-wheelers sold was electric. So 35% share. That doesn't have a massive impact on oil demand trends as such, but the economics here are quite compelling. And unlike some other modes, they can cope much better with weak electricity networks. There's been progress too in the deployment of electric vans, buses, and heavy trucks, despite much, much lower numbers. You'll see I had to alter the scale here. If we look at the sales from a regional perspective, very clear the role of China in some of the current trends. And that's a question of industrial strategy as well as energy security. Largest EV market in many transport modes, 98% of 2- and 3-wheelers sold, almost half of the light commercial vehicles sold, almost half of the light commercial vehicles, and virtually all the buses and trucks. So much for the starting point. Let's have a look now at the future. And of course, when we get past our next couple of years, we get into the world of scenarios, and the presentation now moves into the realm of the World Energy Outlook. I have to say, it's not the new outlook that we're launching next month, but these are the most recent projections that we've published for each of these 3 ways of thinking about the future. They have some things in common: economic, population assumptions, very dynamic representation of a range of technologies, important differences. The top 2 that you're looking at on the screen are exploratory. So they fix some starting conditions and see where they lead. And the stated policies tries to show where we're heading based on a sort of bottom-up, sector-by-sector analysis of what governments have put in place or what they say that they would like to achieve in these sectors. It doesn't include long-term targets unless they're fully backed up by policies and measures to release them. As you can see on the screen, a flattening of CO2 emissions, even as the global economy and population continue to grow, but no noticeable decline. And so depending on what happens post-2050, and if you make some reasonable assumptions for other greenhouse gases, that would put us on track for warming of somewhere close to 3 degrees by 2100. The next line down, the yellow one, that's an experiment to see, what would the trajectory be if we took at face value all of the aspirational pledges that governments made, including net zero pledges for 2050 or earlier, or in the Chinese case, for 2060. Still 20 gigatons of emissions in 2050. But this kind of trajectory, again, with plenty of assumptions about what happens in the second half of the century, that would be compatible with a temperature rise in the kind of low 2s. And then the work that we published in May, around which I'm sure we'll have some more discussion today, net zero by 2050, very different kind of exercise. It works backwards from a fixed outcome, a 1.5 degree stabilization in global temperature, very strict adherence to that trajectory of the decline in CO2 emissions in order to keep to a very limited carbon budget. That's obviously a very demanding trajectory for the energy sector, well beyond what today's pledges would achieve. But as we're all aware, it's central to the conversation in the run-up to COP, and that's the reason why we took this analysis. Need to mention that this is a net zero scenario. It is not the net zero scenario. It's very tough. It's very narrow. And I'll come back in a second to what the sort of energy system transformation that this would imply. But first, a quick look at what the oil demand trajectories that are associated with each of these scenarios. So I think Marianne's described very well the dynamics in some of the scenarios that see continued growth to 2030 before a plateau. That's very much in line with what we find in the stated policy scenario. A decline if you take announced pledges at face value, but with a floor at around 80 million barrels a day. And then that precipitous decline that you need in a net zero emissions by 2050 scenario. Although, please note, net zero emissions, but still more than 20 million barrels a day of oil consumption in 2050. That's largely for non-energy uses, but it's also in some sectors that are extremely difficult to abate. And the aviation sector is probably the most prominent of those. Little bit more detail then. I've decided in this presentation not to just show oil, but to try and understand the broader energy system transformation. So I don't believe you can look at oil in isolation for this discussion. And you'll immediately see where the challenges for transitions. Oil here is represented in red. And please note that this is total final consumption. So we're not asking here where the electricity comes from. It's just the end use sectors, the key end use sectors of industry, buildings, and transport. And you can immediately see where the challenges for transitions, transport fuels, they are no longer, as has been in the case, a reliable motor for oil demand growth. But there's still a pretty reliable stronghold in this scenario for oil consumption, and therefore also for emissions. And we can come back to some of the reasons for that. Now, if you move on and take a view on announced pledges. So this includes all of the European Union's net zero pledge. It includes the United States. It includes China by 2060. What effectively we see here is a really multi-speed world, very rapid transitions in countries with ambitious pledges, notably in the ones that I mentioned, but this coexists with slower momentum elsewhere. So there's a very marked shift in the geography of demand towards other emerging and developing economies. A stronger drive to electrify the transport sector so that if you're in Europe or in one of the countries with the net zero pledges, already by 2030, 50% of all cars sold are electric. And there is the first signs of more rapid change in some of the other sectors. Over 20% of heavy trucks sold in countries with these ambitious pledges are electric or fuel cell by 2030, whereas sales elsewhere are less than 1%. So some momentum on that road transport side, but aviation, shipping, still much more tricky. And you can see on the left-hand side of the screen, continued growth in industry that's primarily for petchems, although we need to have in mind that is a non-combustion use of oil. And finally, the complete transformation that we have in the net zero scenario. Huge ramp up in clean technologies precipitates a very rapid fall in oil demand. Norway has successfully sold car sales in Norway. I think it's over half now are electric. Everywhere would need to be Norway by the end of the 2020s. So 60% of all new cars sold in this scenario worldwide by 2030 are electric. But very rapid changes in other sectors as well. So electricity plays a big role also in the freight sector, although supported by hydrogen and hydrogen-based fuels. We need plenty of innovation in battery technology and elsewhere to achieve that outcome. In shipping, energy efficiency plays a big role early on, but you need advanced biofuels, hydrogen-based fuels such as ammonia to displace oil there. And then aviation, biofuels again, but we still need some residual uses of oil to meet aviation demand, even with some quite ambitious assumptions about modal shift and even some behavioral change there. I won't get into further details here because I think I've used up my time, but I look forward very much to the chance to get into discussion with you all and with this very distinguished panel and to hear your questions. Thank you ever so much.
Tim, thank you very much. That was really interesting. I see that our listeners and viewers are already starting to fill the Q&A box up with questions. Before I introduce Eirik, Marianne, I just want to trigger something that your ESG comment right at the end I thought was really interesting. And one of the questions that I've had is why are so many people skeptical of the ESG value of methane control and remove options like carbon capture and storage? And Tim, I really appreciated the comment that you made about the stated policies and announced pledges, scenarios driving the endpoint for carbon, where the net zero scenario, the endpoint drives the policy. And I think that that's a very, very important distinction for people to understand the message that the IEA was trying to give. Eirik, I think it's time for you to pull up your slides. And while you're doing that, let me just say that that Eirik is the Senior Vice President and Chief Economist at Equinor. That's Norway's multinational energy company. Eirik is responsible for macroeconomics, energy and commodity market analysis, geopolitics, competitive intelligence, as well as regulation in Equinor's commodity markets. Eirik has broad experience in government and academia and in private sector companies, not just at Equinor. So Eirik, over to you, please. Thank you very much.
Thanks. I hope you can see my slides.
Yep, seeing those perfectly.
Thanks for the kind introduction, and it's great to be here. Good morning in the United States, good afternoon elsewhere. It's also good to be, I guess, one of the few people probably that drive an electric car on a daily basis. And being in Norway, we are now, as Tim said, at 65% of the new car sales being electric. That is not possible to copy for any other country in the same way quite yet. It's driven by massive policies and subsidies, mainly. And in spite of the 65% new car sales that we have, we're only recently seen a significant dip in the sale of gasoline and diesel. So, which are now down by roughly 15%, I would guess, compared to the peak it had in Norway in 2016. So, and that also serves to show the importance of getting the new car sales up so that we gradually get the fleet impact. Because we're in a situation where the global car fleet grows, and the cars that we put on the road now will continue to use whatever fuel they're running on for 20 more years. Right? So that's one part of this. Coming after IEA and talking about global scenarios makes us a bit humble, but I'll give it a try. We do Energy Perspectives, which is our publication, and we're into the scenario business, and we go out to 2050, and I'll try to give some views on where global oil demand might go. Starting out with the short term, COVID-19 is and was a shock with profound impact, as both Marianne and Tim has focused on. Oil demand in particular was hit. I just also want to underline that the human toll of COVID is not over. And in terms of number of deaths, 2021 will probably be a much worse year globally than 2020 was, because we haven't seen the end of this anywhere, and in particular in the large emerging countries of the world. The human tolls of this crisis is far from over, even though we have the vaccines helping us in the northwestern part of Europe and in North America. So that's also something to think about. Of course, with the global stimulus, the economy coming back in parts of the world, oil demand will grow and is growing, and will come back to the levels it had in 2019, probably sometime next year, and it will continue to grow. There's no reason to believe that we have past peak oil quite yet. If you look at the right chart, it's something like the Apple index that Marianne looked at. This is a community movement. It's a bit of a different kind of index, but here we have some countries where we're not back to the levels in total where we were in 2019. There's ample room for moving more, and then we also have a growing population going forward. So more people will move more, and increase purchasing power. So we have a lot of free spare capacity in the global economy still, a lot of unemployed people, a lot of manufacturing processes that can continue to grow. Every reason to believe energy demand will go up, we will move more. The global energy mix is still 80% fossil, so fossil fuel use will increase, CO2 emissions will come up. And that's the situation we are in. And then we can hope to change some of that by rapid policies followed by energy efficiency improvements, maybe consumer changes as well. But that requires politicians to dare to challenge the 7.5 billion voters and not only on focus on the supply side of the energy mix, which they are unfortunately doing at the moment. So when we look out of the window and we ask the question, where's the energy world moving over the next decades, and what would then be the implications for oil demand? Well, the answer to that question depends very much what window you look out of, what you're focusing on, what signpost you choose to assign weight to, because we get different signals in terms of energy efficiency development, technology development, climate ambitions translated into climate policies that actually work. Market regulations that are necessary to change in order to facilitate the growth in intermittent zero marginal cost electricity generation as examples. Not to mention our lack of ability to cooperate, geopolitics. The geopolitical climate is not conducive to addressing climate change. Not at all at the moment. And that is, we think, an absolutely necessary condition for us to be able to address the climate change challenge. So when we look, if we focus on some of these red variables here that we can see, populist policies, beggar than neighbor policies, the nationalism that we have introduced in terms of how we distribute vaccines, as an example, the development of global institutions, geopolitical uncertainty, geopolitical conflict, uneven recovery between rich and poor, continued trade restrictions on countries like Russia and Iran, conflict between Europe and China on the one hand in different parts of the world, we can very easily paint a picture of a scenario that we call rivalry. If that world continues, we will not reach climate targets. We will have lower economic development, lower technology development than in some of the other scenarios. We cannot exclude it from happening. Nobody wants it, but in fact, we are on that trajectory in very many important variables at the moment. We have a middle scenario developed from some other signpost. For instance, that the economic stimulus is taking a very traditional approach now. It's focusing on economic growth. In real numbers, not that much on an energy transition or green deals, but on ensuring employment, building infrastructure, rebuilding the economies, focus on growth. We see some of the inflationary impact now impacting solar capacity growth slowing down. And we see the usual volatility in commodity prices, and we can see a focus on markets and technology driving the development, less so than policies. If that takes place, we're in a scenario called reform, which is very much very similar to the stated policy scenario in the IEA. Significant improvements in energy efficiency, significant improvements in carbon intensity, but not enough to reduce emissions to sustainable levels. And then we have another scenario where we build on the possibilities of where you can see some signposts, the increased focus on net zero ambitions, the Chinese net zero ambition by 2060 being the best example and the most hopeful example. Growing support for CCS and hydrogen, the United States coming back, taking leadership on climate issues, a very good piece of news. We've used that to build sort of the elements of a story where we do a backcast like the IEA net zero emission scenario. We call it a rebalance. It's not a forecasting scenario. It's almost a net zero emission scenario, but it's not a 1.5 degree scenario. And notice there is a huge difference between achieving net zero emissions by 2050 and being on a 1.5 degree trajectory. The carbon budget challenge that the IEA has addressed is massive because of the need to change something basically yesterday. I'll show you that here. So in those scenarios, the lines here show our pathways for energy-related CO2 emissions. And we compare this here with the IEA scenarios, the STEP scenario, the sustainable development scenario, and their most recent net zero emission scenario. And very different stories. Reaching net zero in 2050 or 2080 or whenever is a massive challenge. A 1.5 degree warming scenario is much more difficult because it requires the massive changes basically today. And notice the difference between our rebalance case, for instance, in 2030 and the IEA net zero emission scenario. This is a 40% reduction in CO2 emissions over the next decade in a situation where we know that the global economies are growing, fossil fuel demand is increasing as we speak. This is the carbon budget difference between that and the rebalance scenario. If we employ IEA's assumption on carbon capture and storage in 2050 to our scenario, we're also de facto at the net zero emissions. We're less optimistic on the CCS part of that, if you like. but we're not even close with our scenario in 2030. One of the reasons, IEA shows that in order to go in their trajectory, oil demand has to come down by 40% from 2018 to 2030. In our rebalance case, it's not that rapid. Oil demand has peaked or peaks next year, and then it starts gradually falling, and it falls faster out in time, but not this decade. One of the reasons why our carbon budget here is probably consistent with a 1.7, 1.8 degree warming, depending on what you think happens after 2050. Oil demand today, this has been covered by the previous distinguished speakers, but of course that shows where you have to address, and what sectors have to be addressed in order for us to reduce oil demand in consistency with some climate ambitions and climate targets. Transport is more than half of oil demand. Out of that, light-duty vehicles make up almost half of the transport demand. Unfortunately, part of this is what we can then hope to address through electrification and possibly hydrogen, but in particular electrification. If we manage a massive growth in EV sales, which then requires a massive growth in the mining and manufacturing of the minerals and the batteries, and allows for expansion of electricity grids that makes it possible to run an EV, operate an EV in a normal manner like we do now and take for granted in terms of a gasoline car. And I can tell you, driving an EV on a summer day, 25 degrees centigrade warm in a flat country like Denmark, is a very, very different experience than driving the same EV in Norway in 20 below, and you go from 0 to 1,300 meter height over a 40-kilometer distance. It eats batteries in that situation. The range fare increases, the need to recharge is completely different depending on the use of the car. And that's what has to become possible. And we think it is possible. We just have to be aware. This is not only about Mercedes saying they're only going to produce EVs in the countries where it's possible by 2030. This is about making that possible, and that has to do with batteries, etc., and range. So we get the same type of wide outcome in oil demand, not almost as the IEA in their scenarios. So there's a story to be told for constant oil demand, basically going to 120 million barrels, close to that in 2050. That's the rivalry scenario, a scenario we do not want to be in, but we can't exclude. And there's a case in the rebalance case where we go down to less than 50% of what we had in 2019. And if you're in the IEA world, it has to go even further down. And that change takes place, mainly, as I said, and normally and naturally, it's basically redoing the transport sector. Use slightly less oil in the power sector where there's still remaining that can easily be taken out in this type of scenario. Get out of oil in buildings and replace that by something else, mainly electricity, and it should be renewable in order to make sense. And the same thing in the manufacturing sector. And then we still have a growth component, which I do not think IEA has in their net zero emission scenario, a small growth component, which is increased uses of oil as feedstocks. 2 billion more consumers, almost twice the purchasing power in 2050 as we have today. We're probably going to need more stuff made through the petrochemical industry. Somebody told me there's 6 liters of oil in my iPhone. This is a slightly smaller iPhone than the average, but so if we have 2 billion new consumers and we have still 1 billion at least that doesn't have an iPhone, that's increasing demand for oil as feedstock. And then just to finalize, where have we seen the biggest change, and where can we see the long-term impact on transport demand of COVID? And I agree completely that the most likely sector where we will never get back to the growth trajectory thought is probably aviation. Hard hit, takes longer to come back, even in a reform type of scenario, where we expect a lot more air traffic in Asia going forward than we've had, but it probably will take much longer to get back to the levels where we used to, as opposed to road demand, where we already see oil demand coming back, and then we need a significant policy change like the rebalance scenario to bring it back down. And also shipping will take a little while to come back, but there we will also see lower oil demand, more electrification, more efficient logistics if we are in a rebalance case. The story is on oil is how quickly will the transport sector significantly change? Thank you.
Eirik, thank you very much. It's interesting to hear your comment about temperatures and performance in the vehicles. One of the issues here for electric cars in Saudi Arabia is that we often have temperatures in the 45-degree centigrade range, and that's Celsius, and that's just
when I turn off my heater / air conditioning in Saudi Arabia, I increase the estimated range of the car
right
by 15 to 20%.
Yeah,
if it's right, the heater and cooler is depending on the difference between the ambient temperature and the indoor.
There are some big ambitions here for electricity to be the half of the electricity in 2030 range to be coming from renewables, especially solar. It's doable. A lot of that will go into air conditioning. And so air conditioning efficiency standards are actually a pretty strong regulatory policy in Saudi Arabia. And that's important. The IEA has actually done some groundbreaking work on the need for air conditioning in developing countries and how that might be supplied. That's certainly worth everybody looking into. Eirik, one last point that I wanted to raise about your comments, and then we'll go to the questions. I'm going to have one question for everybody, and then we'll try to open this up to our audience. The observation is, when in my opening remarks, I said that the energy transition seems to be complex. And I noticed in your second slide that you outlined the factors that you were looking at in your scenarios, and they were economic growth, energy efficiency, technology development, climate ambitions, market regulations, and geopolitics. And I think it kind of brings home why we struggle as analysts and forecasters trying to show plausible futures and make predictions and why they can go wrong. Marianne, I wanted to come back to you. I noticed that in your trajectory slide that you had the IEA's net zero 50 global oil demand and BP's net zero scenario in there too. And Tim mentioned that 60% of the new car sales in the year 2050 would have to be EVs. Could you just comment on that a little bit? How do you see the EV from your standpoint? How aggressive can we get on EVs and still be in a good range of forecasting?
Right. I don't want to speak for BP, but comparing BP to the IEA net zero cases makes an interesting comparison. BP moves more slowly to the net zero 2050 trajectory. They end up getting there by 2050, but they don't start out as aggressively as the IEA's forecast. And one of the largest differences between them is 2030 appears to be the extent of EV penetration. The IEA, it's mentioned several times, is like 60% of new car sales for passenger vehicles being EVs by 2030. In BP, it's in the 20+%. Today, the percentage is 5%. And the IEA gets to 100% of new car sales faster than BP, even beyond 2030. And BP doesn't get beyond about 90%. But I will say about BP's forecast is they have a lot more, I don't know about the IEA, but they have a lot of vehicle miles traveled by the EV. So they compensate for that in that way. So there has been significant progress in EV penetration, as Tim has already shown. Europe, China, California. But there are some reasons why I believe it will take longer to get to the 60% penetration than the IEA scenario needs to have it occur to get to the carbon balance. While Europe may reach Norway's percentage share by 2030 due to aggressive policies, I think it's unlikely that most developing countries will be able to move as quickly. They may not have as reliable electricity, And they need significant investment in the electric grid or even in distributed grids and charging infrastructure. And where is that money going to come from? EVs also need to be affordable and not higher cost than conventional cars, which comes to my next point. Battery technology is viewed as unlikely to be cost competitive with conventional engines before the mid-2020s. And density or range need to be increased and charging time reduced before many mainstream consumers will accept them. A large number of charging stations are needed to reduce range anxiety, which Eirik says he's experienced, but they may not be economic for private investors to build, since most consumers really aren't going to use them, but are mostly going to charge their cars at home if they can. So you have to subsidize that by governments. Furthermore, a large increase in the need for battery metals could delay batteries becoming cost competitive with conventional cars. So I think I'll stop there, but I will point out one thing that I'm curious about. The IEA has a lower percent, or says it has a lower percent of carbon capture and storage and a higher percent of hydrogen use versus the average of the 18 relevant IPCC pathways they look at. And that could mean that they have to move the transportation sector off oil faster to meet their carbon budget. So I don't know if Tim's going to have any comments on that, but I don't know how BP compares with that.
Thanks, Marianne. I think I might have misspoke. I think I said 60% by 2050, and you correctly said by 2030. We'll have to have a lot more electrification by 2050 to make this work. And I think that I understand and agree with the points that you made. I think that just shows that this is not going to be easy. It doesn't mean we shouldn't get started, so I want to be clear about that. Your point about the where we are with the SP1 issue, and Tim, I want to come back to you now. I love that Economist cover slide. You ahead of our launching the webinar today, you said that you thought maybe you should put a question mark. Is this time real rather than a statement? How do you, one of the things that, and I'll just kind of as a lead in, the whole concept of the socioeconomic the pathways that that have been used, and Marianne just mentioned that, is they show a dual axis of behavior on one end and mitigation on the other axis. And the SP1 pathway, which is kind of gets us where we need to go, assumes fairly decent, that the challenges associated with adaptation and mitigation can be overcome fairly easily. And I want to kick it back to you on the Economist covers. Is the reason that we keep going wrong is we just can't get consumer behavior right? I mean, maybe that's the...
I mean, it's a great question. I think if you're asking about the way that consumers behave in our scenarios, I mean, there is a perception out there that the net zero work relies heavily on behavioral change. I wanted to put that in some context, if you like, because I think it is a little bit of an over-reading of what actually happens there. Clearly, those consumer choices in that scenario are driven by the context in which consumers find themselves, the price context, the policy context, and in that scenario, there's an overwhelming push by governments to bring emissions down. But in terms of the way that those emissions reductions are delivered, so around 40% of the emissions reductions in that scenario, they wouldn't necessarily be felt directly by consumers. There's not much direct engagement there. It's happening upstream from them in the way that electricity is generated, or the way that cement is produced, or the way that steel is produced. The bulk of the change there, it's around more than half of the emissions reductions. They they require the deployment of low carbon technologies, but they also require some buy-in from citizens. So you're installing a solar water heater, or your next car is an EV. You have to adapt a bit in order to accommodate to those changes in the scenario. And then a final 8% of the emissions reductions, they do stem from roughly half and half from behavioral change and improvements in material efficiency. And if we look then at that 4% that's about behavioral change, I mean, it is things like flying less for business purposes. It is some transport shifting to cycling, walking, or ride sharing, buses, where we might previously have taken cars. It's a bit more regional train transport instead of, shorter haul flights. It's those kinds of things, and also some reducing some wasteful energy use in road transport and in beyond efficiency. So maybe having a slightly lower temperature in houses where they're heated, or tolerating a slightly higher temperature where they're cooled, and those kinds of changes. But that's not, I mean, they play an important role, but let's not imagine that they're the key thing that leads to the changes that we're talking about.
Thank you, Tim. That's a very true observation. I just saw today a poll that somebody did, a collection of forecasts, and a number of the big consultants were asked what they thought business travel would rebound to in 2022, 2023. And they seem to range anywhere from about 60% of pre-COVID levels to 80% of pre-COVID levels. Nobody seemed to be predicting 100% or growth. And again, I think that's an area where maybe we'll see what happens and why. My view is we're not going to be able to electrify flying anytime soon, and so we're going to need remove options to deal with the need for jet fuel. So let me finish off with the last question for Eirik. Eirik, you're in your rebalance scenario, oil demand falls pretty sharply, especially in transportation. I think you highlighted that. But it also goes down in the power sector, buildings, and industry. And I think the only growth that you had was in feedstocks. So the chemicals, petrochemicals use of oil. Can you, in the rebalance scenario or some set of that, I do know that net zero ambitions are included. Are there net zero pathways? And I think you alluded to this a little bit, that would have greater oil demand potential. I think you said your net zero pathway has higher demand for oil, but it doesn't achieve 1.5 degrees. Are there other factors in there that you might help us with in terms of how demand for oil might be different in these scenarios? Thank you.
Yeah, I think it's fair to say that within a carbon budget, you only have so many tools available. So whether we're talking about a 1.5 degree carbon budget or a 1.7, 1.8, and if you were to have a higher oil demand trajectory than we do in our rebalance scenario, but within the same carbon budget, then that means that the remaining coal has to go faster. There's not a lot of coal, so that doesn't help a lot. And then that means that with a growing electricity demand, you gotta then grow your renewable electricity faster to take out that remaining coal. You would have to take out more gas at the end, natural gas, to keep more oil. That can happen as well, but then you'll have the beauty about gas is that you can use that in very many sectors, right? It's not only power; it's in the heating sector, it's in manufacturing, and also in transport. So those are the alternatives within the fossil fuel space. One of the main reasons why IEA gets further down is, of course, they're slightly more optimistic than we are in carbon capture and storage. So for any, if you're more optimistic on carbon capture and storage, but then there's room for all of that, more fossil fuels within the same carbon budget, and ultimately you end up with negative emissions. So what do you think about natural sinks and the bioenergy with carbon capture and storage and so on,
Right.
which some of the IPCC scenarios have massive numbers, right? But that is frankly much more difficult to explain than some of the relatively radical and crazy assumptions that we have and IEA have. But those are the tools available, and that's how it is. And the other way, of course, is to well, if you want higher oil demand, it has to take place within a certain set of energy demand growth. I mean, if you're just focusing on emissions, you can get emissions faster down also by assuming lower economic growth, which I do not think is a recipe for sustainability in the 16 other dimensions than climate change.
Eirik, that actually leads into one of the questions that's come up on the chat. And it was, you had geopolitics down as one of the factors. And how do you see geopolitics impacting CO2 outcomes? And I think you just gave one example.
Yeah, that's one example. I mean, but it's we believe fundamentally we believe that if we don't cooperate, if we're not in a collaborative mood where we share burdens and share financing and share technological solutions, then we are in a very bad position to find good collective answers to collective challenges, and climate change is one of them. The technology development also depends on us trading on technologies and so on. So everything that slows that down. If we have bad political relations to a country nearby us that happen to have a surplus of an energy source that we would like to replace our own with, and I'm talking as an example, natural gas from Russia to replace coal in Poland. If you want to speed up that transition to get emissions down, then that is much easier done in a situation where the political relations between those two countries are relatively good than if they're bad, as an example. So that's how we think about it.
Right.
So yeah, and the financing of this, we in the rich world will have to think about how do we speed up the transition in the emerging economies to make this possible. That also depends on political relations in many different dimensions.
I was just going to add that as a thought. In the IEA's net zero scenario with very low oil demand, to me, one of the geopolitical questions is what happens to those countries who are extremely dependent on oil sales, exports to drive their economies. And that geopolitical issue is not there. I was actually on a seminar a month or two ago where there was a peer-reviewed paper suggesting that rich countries should subsidize oil producers to not produce. And all I could think of was the problems we've gotten into with agricultural policies doing that, and I really didn't want to go there for oil, but it's another aspect of that geopolitical situation. Marianne, one of the other questions that's up here, and maybe you and Tim would, or all three of you might want to comment on this one. Could current policies that seem to not favor hydro power, nuclear, natural gas, could they be inhibiting a more realistic transition? And if we tried to go that direction, is that something that might lead toward? I mean, the question ended there, but let me just add on that maybe that leads to Eirik's rivalry kind of scenario. What anybody want to comment on that? Marianne, why don't we start with you?
Sure. Well, I'll comment it from a natural gas perspective. I don't think we're taking the full opportunity to use natural gas as a way of moving faster to reduce CO2 emissions, switching from coal to gas or from oil to gas in the power sector. moving oil out of the industrial sector and replacing it with gas. But the key there is the industry has to reduce methane emissions and stop flaring gas. I mean, that is a necessity, and that's what it's going to take to do that. And the interesting thing about stopping methane leakage is that's an important way of getting a potent greenhouse gas out of the air very quickly. So that, that to me is actually part of the solution. And I also think that we need nuclear in this as part of the solution, because we're not going to get some of these new technologies maybe as quickly as we'd imagined. So there has to be a role for nuclear, but outside of China, it doesn't seem like that's occurring.
Right. Tim, would you like to jump in?
Yeah, I think there's each of these elements, hydro, nuclear, gas, has its own distinctive features. I mean, in the case of nuclear, in most economies around the world, it's really a question of what you do with your existing facilities. Mm-hmm. And I think, nuclear's 10% of the electricity generation mix. If you're aggressively moving to remove that from the mix, obviously you have to scale up other clean generation options that much faster in order to decarbonize your power. So we've been making the case, at least for countries for which that's an acceptable political solution, is really look at options to extend safely the life of your existing generation, because that's a sort of bedrock of the existing low carbon generation, and I think it can play an important role. We do have an expansion of nuclear in our scenarios, and there's obviously some technology possibilities, some innovation possibilities. Many countries are looking at the possibility of smaller modular reactors, and that would be a better fit with the sort of power system that we imagine that we'll have in the 2030s and beyond. And just to say on natural gas, it's very difficult to give categorical answers to questions about natural gas because it's so geography specific. Mm-hmm. And I think the debate in Europe is obviously going to be different from the debate in many parts of Africa, for example. And there was an article in the latest Foreign Affairs by the president of Nigeria making many of the arguments about why continued investment in gas in Nigeria makes sense. And it was, as many people will be aware, that the US Treasury recently came out with some new guidance about funding for fossil fuels from multilateral development banks. And there, gas was treated very carefully, but there is a carve out there for gas investment in the least developed economies with some conditions. It's got to be accompanied by a credible analysis that shows that there's no economically or technically feasible lower carbon alternative, and you've got to be wary of locking in. But I think you have to recognize also that for many economies, particularly those with weak electricity infrastructure and industrialization ambitions, that this can play an important role, particularly, as Eirik said, for the other SDGs, poverty reduction, air quality, and various others.
And a comment from my side also is that, all these sustainable development scenarios, they depend on a very large number of massive changes on the supply side of the economy, energy spectrum, in order to realize the possible reductions in the demand for fossil fuels. There's no silver bullet here. So if we do not stop the decline, if you like, of nuclear and get a growth in nuclear electricity, if you do not allow gas to be a potential source for hydrogen when you can combine it with CCS, you're going to make this transition so much more difficult. It's going to be, because you're developing a market for green hydrogen, you better wait until you have a surplus renewable electricity, and we don't have that. So opposing carbon capture and storage, opposing natural gas will slow down also a transition to hydrogen. If you don't believe in nuclear, you better find other ways of replacing all that coal, and at the same time have an efficient electricity system that also delivers electricity 24/7, 365 days a year, etc., etc. And then what we see is, of course, that in reality, there's a lot of political resistance against the infrastructure that is needed to do this transition, whether we're talking about pipelines or storage or battery. The next fight is going to be on seabed mining of minerals, or what do we do with the existing mines if we have to increase the output of some of these minerals several tenfolds within the next decade. who's going to start protesting against that type of nature? And we see the opposition against offshore wind turbine, onshore wind turbines in Norway now. Pristine nature. So those types of issues as well. And all of that will slow down the possibility of delivering on this energy transition in a sustainable manner.
There was, Tim made an interesting comment just a few minutes ago along the lines of the difficulties of kind of what I would shorthand my phrase that there's no one size fits all strategy that works for every region or for every country, and each country is, and I think we should, my view is we ought to encourage every country to contribute in every way that they can. And if that involves something that, if that involves nuclear, then it should be. There was actually a pretty interesting debate on this in the G20 last year, and I think it will continue. And that is, can you move towards a more integrated or holistic view that says that you'll allow all of the tools in the toolbox to be used? That, look, if green hydrogen is the way you want to go, please do. But maybe blue hydrogen, which might get you a good way towards the goal, if that can work, let's not throw out nearer term practical solutions in favor of things that we can't get done immediately. So I think that's kind of important. One of the other questions that came up, and maybe it kind of fits into the conversation we're having, is how do we figure out whether government policies can be scaled up to the, as needed? What are the, and I think everybody here has commented at one point or another about investment. So the financial and regulatory aspects associated with the energy transition and moving towards a net zero seem to be pretty important. And government, I think, is going to have to play a strong role in that. Marianne, let me start with you on that one and ask you for a comment, and then we'll go to Eirik and Tim.
Well, I actually have a debate with myself about what the role of government should be. I mean, do we want government to pick winners and pathways and then encourage investment in those specific things? That might be a very effective way of getting it, but it's likely to be higher costs than if you just said, here's a performance standard you have to meet. Investors, consumers, everyone figure out the best way to get there, but keep the performance standard. So as the economist in me wants to go with the latter approach, but then you have all these experiments going on, some of which lead to investment that doesn't amount to anything in the future. So I'm actually torn about which of these approaches the government should take. But back to your question of the scale up, what it takes. I mean, the question is, do countries have the political will to actually do these things on such a grandiose scale? And I agree with what Eirik said earlier. It really comes down to the geopolitics. But I'm seeing in US surveys a change in attitude with all the wildfires and floods we've had. I think there may be a change in attitudes, which would give the cover to politicians to allow them to do something grander. But the real test will be, can governments actually implement and fund the policies that go behind their large ambitions? And that to me is an unknown.
Thank you, Marianne. Eirik, what do you think?
Oh, I have a lot of sympathy with Marianne's point here. And the question is, of course, first of all, there's no chance that we can get to where we have to get to during the next 3 decades, unless we have a significant step up in government policies, and that across the globe in different ways. And it has to go away from talking about increasingly hairy targets and ambitions and start putting in place measures that actually bend the curve and make. We're talking about the external effects here that you and I do not have any incentive to take into account when we choose our behavior. That has to be fixed by some kind of government regulation. In Europe, we tend to like taxes better. In the United States, the country was basically built on protest against taxes. So there's something about other types of regulation. It should be done efficiently. That's not about picking winners. It's technology neutral things. Otherwise, it will become more expensive. This is the first time in history that we will have to do a proper energy transition. So far, we've only done energy additions. Even digitalization leads us to use more energy, right? I mean, we use 60% more coal now than we did in 2000. So now we have to get our energy demand flat and then down. That's a completely different task than adding on new sources of energy and just allowing demand to go. Germany have tried billions of euros to make homes more efficient. The result of that is that the winter temperature in Germany indoor is 2 degrees warmer than it was 10 years ago. So in order to avoid those types of behavior, we also need policies that through prices or through legal restrictions on what we actually are allowed to buy, for instance, EVs versus ICs, in order to make the change, we need those types of policies. And we probably need carbon border adjustments of some kind in order to make sure that that our neighbor doesn't run away with all our manufacturing capacity.
Tim, over to you.
Yeah, I've lots to agree with there, but I mean, clearly this is if this is going to happen, it's going to be happening with a heavy role for governments for all the reasons that have been mentioned. Interesting to consider what kind of government intervention we're talking about, because a lot of the models, not necessarily the ones we use here, but a lot of the climate models rely very heavily on CO2 pricing to force change. And I mean, there is a strong opinion, particularly in the academic and economists community, that CO2 pricing is the first option you go to effect change in an energy transition. And certainly there's evidence from Europe that it works where you have sort of mature technologies competing against each other. There's much less evidence that a CO2 price is effective at bringing forward the technologies that are not ready for the big time yet, but that we know we'll need in heavy duty transport or in cement or in all sorts of other areas. So, and there are big questions also about whether the politics of carbon pricing work. I mean, economy-wide carbon pricing, let alone sort of global pricing. So I think you're going to have to look at a range of regulatory measures that sort of attack problems in a discrete way, whether that's in bits of transport or in the power sector or in energy efficiency. So again, we come back to something that you said before, Adam, that there is no sort of universal truth that you can apply across different parts of a very complex energy system. And so, there will be this sort of messy range of policies that are designed in each country to their discrete and unique, their circumstances to try and push the changes that are required.
Tim, that's a great point. It reminds me that one thing that it would be probably a great idea to get a more universal agreement on is the metrics associated with measuring performance in the carbon area. And that sounds like something that would actually be a pretty good thing for the IEA to work with others and look for opportunities. And Eirik, I had to laugh your comment about the United States and taxes. When the U.S. came fairly close back in 2009 to a cap and trade program for emissions, and they clearly the politicians of political groups found that more palatable than taxes. And here it's in the Kingdom of Saudi Arabia, there's been a strong effort to look at, can you do carbon to value, right? Can you actually find a price for carbon, a product that actually has a value associated with it, in the marketplace? There's, some uses of CO2 into fertilizers and methanol, ethanol, and some areas where you can actually make money doing it. There is hope that maybe carbon cured concrete might actually be possible. I think back to Tim's point, or maybe I think a point that everybody has raised here, I think that maybe one role for government might be to try to look for, governments everywhere, to look for within their own countries, those areas where they have the best shot at making carbon into value, and then doing demonstrations associated with that to get the experience associated with moving this forward. There's another question here that I thought, Marianne, it was for you, but I'd be happy to have anybody chime in. The question was, is there a possibility that supply might not keep up with demand if we see demand growing at the upper ends of the different ranges? Eirik had one where we were headed up to 120 million barrels a day. How do you see the supply? I guess supply might not be a problem if we have peaked, other than the geopolitical issues associated with that. Over to you, Marianne. I don't know whether you want to comment on this.
Yes. I think it's a real issue that we need to worry about, because investors have been very unhappy with the oil and gas industry for poor historical returns. So that's already depressing equity prices of oil and gas companies relative to the crude price level. So now we're adding ESG pressures on top of that. And I see things like the majors buying back their shares, all things to improve returns and have investors still think their stocks are attractive. Reducing debt. Some of the European companies have announced that they are actually going to decline their oil production as a policy matter, as a way of reducing greenhouse gas emissions. So I do see this as being a potential issue if we're on that upper demand growth trajectory. Obviously, if we're on the IEA's net zero path, I don't think we really need to worry about this. The other thing that I think will happen is the non-OPEC players are going to be much more sensitive to ESG pressures than the national oil companies. So I can see supply shifting more towards national oil companies. And some of that comes with greater geopolitical risk. And some of that is that, they've been reliable suppliers in the past, like Saudi Arabia. And so I'm not as worried about that, but it really does change. Everyone is thinking that there's less risk in oil supply because the US, tight oil production is such a large percent of it. Well, a lot of policies, if you're really serious about reducing greenhouse gas emissions, you may not, in fact, be the federal leasing ban might continue in some form. There might be policies employed that would make the US less of a reliable sort of, it's a marginal supplier, not because of its cost, but because of its quick response time. So there are aspects of it, energy security aspects, I think, as well as the potential, if the demand keeps going up and supply is going down, as we would say, Houston, we have a problem.
Tim, I know that the IEA has been concerned from time to time about the investment availability to make sure that supplies are available. I think they were talking about oil, but I think that this might be true in different areas across the energy sector. Would you like to comment on that?
Yeah, I think we definitely agree with that. We track the amount of capital flowing into the energy sector here at IEA. It's about $2 trillion each year. Had a dip last year, of course, but we anticipate it's going to get back to around there in 2020. In volume terms, that's not enough for what we think we will need for the future. In geographical terms, it's not going to the countries where energy demand is increasing fastest. And it's simply not going to the sectors that would be required to grow very rapidly if we are to have a successful energy transition. So in a way, we're caught between two worlds. We're not investing enough to maintain the system that we've had up until now, and we're not investing enough in the new stuff in order to change rapidly. And I think there are multiple warning signs there for energy policymakers and anyone else to worry about.
That's a bit scary. Eirik, we're going to give you the last comment here. How does it feel to be a oil and gas company in this scary world of energy transition.
Well, it's exciting. I guess, and I agree that we're going to see a lot of volatility here in prices. I mean, that's where you see it first when there's a shortage of something. So, but I know I used to say that in the energy industry now, like in the transport industry and the construction industry, I guess we're between a rock and a couple of hard places. So on the government side, we are challenged to deliver on their climate targets without them having to put in place all the unpopular measures that are necessary to deliver on that, like a carbon tax. On the consumer side, they would like us to deliver on their energy needs with much lower emissions without them having to pay higher prices. And increasingly on the financial side, the financial investors are expecting us to change our business model, deliver new energy, but without reducing the rate of return. That's a very hard place to be, a very tough place to be. And increasingly that we will share that hard place, I think, increasingly with national oil companies and others. But at the moment, that is something that the IOCs and utility companies in the West, the transport companies and some of those that's where we are. And we're not sharing that place with everybody else yet. So that's so we got to fix this on all kinds of all those dimensions. This transition will cost money, and it will be difficult in a transition period, and that has to be open.
It's a really interesting point, Eirik. I'm going to turn it over to Dave Williams in just 30 seconds, but let me just add that your point about national oil companies feeling some of the same pressures is, I think, an interesting one. Saudi Arabia has said that they really, truly do not want to be part of the problem. They really want to be part of the solution, and they would like to lead in trying to find solutions to the climate challenges. And there's a big effort underway here to do that and to put real money and real investment behind some of these ideas in areas like hydrogen and carbon capture, in nature-based solutions, greening, and so on. But it's the same pressures exist. There are competing needs for funds, and you're always looking. You're trying to do the right thing, but still keep economies going and consumers and citizens happy. I would really thank Marianne Kah, Tim Gould, and Eirik Wærness for these terrific presentations and answers to these questions. And now I'd like to turn it over to Dave Williams, the Executive Director of the International Association for Energy Economics. Dave?
Thank you, Adam. And thank you, Marianne, Eirik, and Tim, really for a truly outstanding webinar. IAEE is committed to continue the discussion on net zero, to continue the discussion on energy transition. We have put a call for papers out for a special issue of the Energy Forum. This is our quarterly newsletter on the topic of transition. Overwhelming response to the number of articles coming in. Will make it easy 2, possibly 3 issues forthcoming. So we're committed as well on our webinar and our podcast platforms to continue the dialogue and the debate. We thank our speakers very much, and we thank our members for listening to this very important discussion and to be part of the debate. With that, it's my pleasure to close this webinar. I wish you all a good rest of the day, wherever this finds you on our fine globe.